Welcome everyone. Chapter 32, the use of financial documents. From this lesson, we are going to find out mainly the organization, business organization, who are the stakeholders while looking at the financial information, especially understand how the use of financial documents to assess the performance of a business and understand how to use the financial document to inform decision making. So these things, especially main stakeholders and their interests, we are going to discuss from this lesson. So you can see normally in getting started part, one reason why business produce financial document is because they provide useful information to help assess the business performance. Right? Normally from financial documents, we can find out a lot of information regarding their liquidity from using SOFP, right? Regarding their profitability or performance by using the income statement. So financial information reading part, the interpretation part, the ratio analysis section was we just finished in my previous session. You can see, and then by this lesson we are going to find out what is the use of this, mainly advantage of this documentation, right? For different stakeholders, what are the different reasons? For example, bank, in the perspective of banker, what they're looking regarding the business security, right? In the perspective of the employees, sometimes they're looking at their job security is the most important thing, so they will looking at the performance of the business. Sometimes government may thinking in different angles. So what today I'm going to teach you what are different stakeholders and different their angles and financial statement, what they're mainly looking at, and like different perspective of different stakeholders in financial document, right? So we are starting this chapter with the case study OJA building supplies. Yeah, teacher, can you read the case study, please?
OJA Building Supplies produces building materials for the construction industry. In 2016, the company began looking for a new supplier of calcium silicate, an important raw material. A suitable supplier was found, but the supplier would not supply goods on credit until it had looked at the company's accounts. The new supplier was particularly interested in the amount of working capital, net current assets, OJA Building Supplies had. The table 32.1 shows some financial information for the business between 2012 and 2015.
Yeah, you can see now the 2000 OJA building supplies they're asking, and there are two case studies actually, OJA building supplies and the Park Farm Food. So this case studies, you can see this building supply case study. You can see their financial information in euros from 2012 to 2015, 4 years. And by looking at this, mainly this extract from the SOFP, you can see current assets and current liability. So we can find out specifically the liquidity part. We can find out easily. We can calculate. It's a building supply. Therefore, mainly the significant amount of current assets consists with their inventory part. 128 and then 132, 123, 121 is gone down the trend. And trade receivables also like that. Cash position also goes down. There's heavy decrease of cash position. 12,000 to 300 level. You can see the cash position goes down, and then total current asset decrease from 219,000 to 187,000. Whereas the current liability, what happened? Trade payables increase from 130 to 165. Other payables also increase. As a result, the total, you can see current liability improved from 154, 148, 68, 93 like that. So there's improvement. So I think the liquidity gone down. For roughly, if you normally from the picture, FID, you can say the liquidity current asset position goes down, current liability position improve. So as a result of the liquidity, we can say gone down. This is situation of the OJA building supply case study, right? Okay, the second case study related to Park Farm Food. Right? Park Farm Food, they are providing the income statement extract, the statement of company's income extract, right? TG, can you read that part also? Park Farm.
Park Farm Foods is a small chicken meat company in South Africa. Marcus van Zyl owns the company, which supplies restaurants and retailers. However, owing to increasing competition from cheap imports, profit has fallen in recent years. He has decided that if the farm does not make a profit of 500,000,
yeah, South African rand.
South African rand in 2016, he will retire from farming. Table 32.2 shows the statement of comprehensive income for the business in 2016.
Okay, thank you. You can see now the 2015 and 16, they are giving the comprehensive income statement. Revenue, what happened? it's gone down 4.7 million to 4.5 million. You can see cost of sale, it's also gone down. Gross profit value gone down 1.5 million to 1.4 million. The administration expenses also slightly increased, 761 to 769. Operating expenses also increased. Operating profit gone down 544 to 451. And financial expenses increased, and then profit for the year has decreased 344,000 to 201,000. So this is the bad year, but because in the beginning of this case, they mentioned the owner wants the Park Farm Food owner is mentioning that he will retire from farming is unless the farm does not make a profit of 500,000. This one. So then normally you can see in he never earned about 500,000 income. Gross profit is there, but 1.4 million. But because of the high expenses, especially administration expenses, it's very high, 700,000. So therefore, is earning a less profit. The profit for the year is low, 201,000. It's gone down from 344,000 to 200,000. So that is he never earned 500,000. He will retire from farming, but they're asking different questions. Which stakeholder is interested in the financial information table 32.1? And what conclusion might the stakeholder in question 1 draw from the information in the statement? And they're asking how will Marcus use the statement of comprehensive income shown in the SOCI, make important decision and obtain the accounts to 2 large companies in your area and compare their performance. So this case study, you can see, let's go to the answers. So you can see chapter 32, part question of 1, which stakeholder is interested in the financial statement? So in this table 32.1, the current assets, current liability section in the OJA building supply, the supplier will use the information. Supply, they want to know whether they can pay their liabilities. Right? They will information they will use, and then they decide whether they can give the company trade credit. If a business is not financially secure, it would be risky of selling goods on trade credit. That's the thing, right? The second question, what conclusion might be the stakeholder in question of 1 draw the information? By looking at the OJA building supply, you can see I told you the liquidity portion gone down, current assets gone down, fall, and current liabilities improve. So you can see here the information on this table shows the working capital portion of the building supply is worsening over the time period, where the current assets fall between 2012 and 15, while the current liabilities rise. Indeed, in 2015, the working capital is negative. Working capital negative because the current assets are less than the current liabilities, and this suggests that the company will struggle to pay its immediate bills. So as a result, the supplier is not likely to grant OJA building supplies trade credit because they might not get paid. So especially people who will give loans, suppliers, bankers, they might looking at this liquidity portion of the business organization. If they are not satisfied with the company liquidity, they will not give you the trade credits, everything. Stop. So sometimes you might be wonder how the supplier get to know this information. If you are a private company, the supplier definitely they can't reach the information because the informations are confidential. Because the private companies, partnerships, altogether, you cannot actually you're not publishing the accounts. But if it is a public limited company, PLCs, definitely anyone can access the information through the websites, through the stock exchanges. You can access to this information because you have a mandatory requirements there. You have to be a public company. PLC, you have to disclose your financial information to the public. Sometimes they do it in newspapers also, they publish the annual report and quarterly report and everything. So as a result, all the public will be get to know about how much they are earning, how much they are savings, how much their liabilities, assets, everything they will get to know. So this is really important. So this case, the mainly suppliers, they are assuming that the supplier can access their financial information like this current assets, current liability information, and they can find out whether they are strong enough to take their trade credits. Right. Question number 3 asking how will Marcus use the statement of comprehensive income to show the statement of comprehensive income to make an important decision. Okay. Yeah, Adil, can you read that para? Question number 3. Right. Ammar, can you read that part? Question number 3. How will Marcus, this case the the owner of a farmer. So he actually used this information, what important decisions he's taking, using the company's income statement to actually make an important decisions. Okay. Yeah. Amma, can you read that part?
So which part again?
Question number 3.
Marcus van Zyl is going to use the statement of comprehensive income for 2016 to make an important decision regarding his future. He has decided that if the farm does not make a profit of ZAR 500,000 in 2016, he will retire from farming. Unfortunately, the statement shows that the farm's profit in 2016 was only 211,000. This is even lower than the profit made in 2015, 344,000. Presumably, Marcus will retire from the business.
Correct. So definitely he challenged that he's not staying in the business unless he's not making 500,000. So he will retire from the business as a thing. So his profit actually only 211,000. So it is significantly less than the last year profit. Therefore, definitely he will, presumably we can say Marcus will retire from the business organization. Like that, you can make some decision, retirement decisions, closing decisions like that by using the financial statement. Okay. Now we are talking about the one by one different stakeholders who wanted to use this financial information, financial documents to assess the performance of a business organization, right? Okay, first of all, managers, right? Because they are using this information, SOCI and the company's income and the SOFP on different reasons, right? So first one, I invite TJ, can you read the managers and employees?
Managers will want to access the performance of the company. The profit made by the business will be a reflection of their own performance. For example, if the company does well, they may be in a position to ask the owners for higher rewards. Managers might also make comparisons with competitors to see how their performance compares with that of rivals. Managers might be more motivated if they see that their company is performing better. Employees might need financial information during wage negotiations. Information about profit and the prospects of the business could be used to decide whether it can afford to meet a wage claim. For example, if the statement of comprehensive income shows that profits have increased significantly, employees will be in a stronger position to demand a wage increase. They may also look at accounting information to see whether their jobs are secure.
Correct. So managers mainly for decision making because they are taking day-to-day decision making. So therefore, this financial statement is their business intelligence. So this business intelligence provided by the financial statement, income statement, SOFP, cash flow, everything. So therefore, they can make informed decisions based on this. They can know, okay, the decisions cannot be it's limited because we don't have enough money, like liquidity problems are there. The managers, they can find out that. Like that, the overall decision making, top level management, middle level management, and lower level management, they can make the decisions based on the financial figures. And also the employees, the bottom layer, the people who are working in the normal general office staff, administration staff, these people we may looking at the financial statements, especially profitability, because they know if their company has a profit, mean then only they will get the increments, then only they will get the salary, bonuses like that. So they will get that information because their job security will be depending upon the business survival point. So the business is okay, business is earning quite good amount of money, then their survival is better. So this profits can significantly they can increase, and employees will be a stronger position to demand the wage increase as a result of that. So this is the thing. So managers and employees, you can see simply identify, manage to make decisions, employees regarding the job opportunities, right? Next one is owners and shareholders. Owners and shareholders, I invite Rahma, can you read that part?
Owners and shareholders. Owners of small businesses will obviously be interested in the performance and the financial position of the business. For example, a sole trader might look at the profit to see if targets have been met for the year. In getting started above, Marcus van used the statement of comprehensive income to decide whether it was worth continuing with the business. He set a profit target that the business needed to meet in order to retain his interest. Shareholders in limited companies will also be interested in the performance of the business. They may look at the size of dividends. They may use ratio analysis to see how their investment is performing and make comparisons with other companies in which they would in which they could invest. The financial documents will also show whether the business has grown. Investors often prefer to invest in growing companies.
Yes, so thank you. So owner and shareholder, they want to find out whether the business performance is good. Especially shareholders and owner, they want to know the business progression, like the track, the mainly their business is actually profit making or loss making, especially performance as well as liquidity. So that's why this ratio, unless like gross profit margin, net profit margin, ROC, return on capital employed, markup ratio, these things are really important. That's why everyone who are listening to this video, you can see here that mainly this is not only looking at the financial statement, it must be meaningful. You must be able to get some idea. So any organization, the financial informations are there. This financial information must be able to read because this is the language of the business, right? That therefore the value of these financial documents are really important because sometimes it will say only accountants can understand. No, as a general person, like if you're an entrepreneur, must be able to know this thing, like because that's additional like a knowledge, because in a business management, once you actually start your career in whatever the path is, marketing, HR, IT, right, financial management, definitely the business finance is really important because especially interpretation part, the liquidity performance and everything must be get some idea whether the business is doing good or bad, especially when you're making shareholders, when you're making investment decisions. This is really important. You can find out the size of the business dividends, performance, and they can compare with other organizations. This is really important. Therefore, investors also to prefer to invest in growing companies, right? Okay, now we are moving into external stakeholders. External stakeholders, I invite TJ. Can you read that part?
Banks need up-to-date financial information when deciding whether to lend money to a business. Banks will look at the accounts to see whether a business can repay the loan with interest. They will tend to focus on the amount of working capital a business has and whether it already has any large debts. Banks often want to look at accounts from several years of trading. They may look for patterns and trends in a firm's trading history. Suppliers will want to access the credit worthiness of businesses that buy resources from them using trade credit. A supplier is likely to carry out a credit search before granting such credit. Suppliers can use accounts to see whether new customers are a good risk. In getting started above, Cork Building Supplies wanted to buy some goods on credit. However, the supplier wanted access to financial information to look at the firm's ability to pay its debts before making any deliveries. The accounts of public limited companies are published and help to inform shareholders about the progress and performance of the company. They are also used by potential investors and financial analysts to help make decisions when buying shares. Financial institutions such as insurance companies and pension funds invest huge amounts of money in shares, so they are likely to examine financial documents very carefully.
Okay, thank you. So main external stakeholders, they are mentioning about the suppliers, bankers, government, right, other competitors, everything, because you must know this, their main idea. So what you need to mainly understand here, bankers want to know their day-to-day, especially the liquidity decisions, whether they can have any amount of like a large debt before like a credit, they're granting a credit, you must know these things. And also suppliers want to actually find out, assess the credit worthiness of the company, the business is like a, before they're giving a credit, sales, credit purchases, right, credit businesses, they want to assess your business organization, the ability of actually able to actually repayments and everything must be get to know. And also the public limited companies, especially competition, because you can able to like a financial analyst, like investors, there are researchers are there. So organization, they wanted to mainly judge your performance. They are doing so many technical analysis based on that. Technical analysis part they are doing based on their net income, revenue, and they make some kind of sense by looking at your organization financial document. Therefore, there are so many external stakeholders are there who are looking at their financial statements. There are internal stakeholders, especially the owners, managers, and employees. And there are so many external stakeholders such as, suppliers, customers, government, competitors, media, bankers, investors. So there are so many people. So everyone wanted to have the information in the financial statement to judge your organization performance. Okay. Okay, let's go to activity number 1, case study Bibblington Pharmaceuticals. Bibblington Pharmaceuticals is a producer drugs and medicines for the East Asian markets, and the shareholders expect a 10% return on capital employed, and they use the accounts each year to check whether this target has been achieved. Table 32.3 shows them financial information for the Bibblington Pharmaceuticals, which has been taken from accounts. You can see revenue 2013 to 16, revenue has increased 45 and 79 and gone down to 47. 2015 is a significant year. Operating profit also improved and then decrease. And then return on capital employed 11%, 11%, 10.9, 8.3. So 2016 was not a good year because performance gone down. But 2015, between you can see they are peak time, peak level, the maturity level is there in 2015. So they are given straight away the for ratios, everything. They're asking what is the main reason why the owners of Bibblington Pharmaceutical use account? What's the main reason? And second question asking discussion question, discuss whether Bibblington Pharmaceutical has reached the target set by the shareholders over the time period. The reason and the target. So target is there. The shareholders wanted to have a target return on the capital employed. They say 10%. 10% return on capital employed. Yes, the 10% they have achieved over the years. 2013, 14, 15, but 16 they have gone down. They are achieved. The objective has not accomplished because it's gone down to 8.3%. 8.3%. So we'll see how this question can be nicely answered in the question. You can see question number 1. What is the main reason why owners of Bibblington Pharmaceutical use accounts? The owners of business obviously be interested in the performance and the financial position of the business. Shareholders in limited companies will also be interested in the performance of the business. They may look at the size of dividends and they may use ratio analysis to see how their investment in the business is performing. And they might also make comparisons with other companies in the same industry. In this case, the shareholders of Bibblington Pharmaceutical set target for the return on capital employed. The shareholders aim to get a 10% return on capital employed. So they use the accounts each year to check whether this target has been achieved. Target has been achieved. So that's why the main reason why they are looking at this one pharmaceutical use account, because look at the size of dividends to kind of make comparisons and everything, right? So look at the target achievement of the shareholders question, because this question the ROCE level they have achieved according to information table 32.3, return on capital employed had exceeded the shareholders targets every year except for 2006. You have to say like that, right? When you're analyzing, you have to say with the facts and figures. So we'll see what are the reasons. And 2016, there's only 8.3%. Although this year is below 10%, the target may not be too disappointing, right? This is the way you had commented. I say it's not too disappointing, even though less than 10. Why it is not disappointing? For example, it may be acceptable if trading conditions were difficult during this time, like right now, 2020, 2021. So target is a very difficult year for trading for a lot of countries because of the pandemic. For example, it may be acceptable if trading conditions were difficult during this time. So it is possible that the performance in 2016 was caused by unusual circumstances, right? And that in the future trading conditions will return to normal and the performance of the business will improve. So I'll say this situation is only temporary situation. The performance will go on down. This is unusual circumstances. However, in future, this will be returned to normal and performance of the business will improve as a result of that, like that. This is the way you have to comment on the performance by using this thing, right? Okay, now you can see the using financial information, the documents in informed decision making. So what are the main decisions you can take? You can take different decisions on the financial information. For example, business will make better informed decisions if they have access to the financial documents. Since the financial documents contain quantitative information, right? Most of the numbers from there, therefore we call quantitative information. We don't have qualitative information like in normally qualitative information we can find from research reports and especially focus to questionnaire. But mainly quantitative information are things like coming from gross profit, operating profit, current assets, current liability, everything, numbers, numerical. Therefore, it will be helpful for decision-making process if you have everything like especially quantitative numbers in dealing with numbers, and may need to up-to-date financial information with regard to this. right? So look at the main decisions you are taking. Funding decisions. Funding decision you can obtain by using this financial information, right? So I invite Kanusha, can you read out the funding decisions?
Funding decisions. Access to relevant financial information can help to predict when more money will be needed by a business. For example, details of current assets and current liabilities can be used to calculate liquidity ratios to see whether the business needs to raise short-term funding to boost working capital. Also, if the business is planning to expand, we can use a statement of financial position to see which type of funding might be the most appropriate. For example, if the statement of financial position shows that the business already has high levels of non-current liabilities, it may be more appropriate to raise funds by selling more shares. Alternatively, if there are high levels of cash resulting from the buildup of retained profits, this might be used to fund expansion.
Okay, so funding decisions is important. If you have enough funds to invest, like this, you can take the example. If you have current assets and current liabilities, you can check and you can say that it can be used to calculate the liquidity of this ratio. With the business, you can find out whether liquidity is okay or not. If you have very good level of liquidity, you can actually use that money. You can raise more short-term funding to boost the working capital, and also you can use the estimation of SOFP to which type of funding might be the most appropriate. For example, like it's better to invest in the fixed asset or like a current assets, non-current assets or current assets. You can take appropriate decisions by like that way. So therefore, it is important. Funding decisions mean like how can you investment decisions basically in non-current assets and current asset invest. Are you going to buy more stocks or are you going to buy more machines? Like that, you can do this kind of a decision based on the informed decisions you can take, especially funding. Okay, second one, reducing cost. Reducing cost one. Okay, Rahma, can you read the reducing cost part?
A business might use the statement of comprehensive income to analyze cost. For example, by comparing the gross profit margin and the operating profit margin over a time period, a business can assess whether costs are under control. If the gross profit margin is rising and the operating profit margin is falling, this would suggest that business expenses are increasing. Therefore, managers might examine the different costs to help identify problems.
Thank you. You can see now reducing costing, you can get some indication by the difference between gross profit margin and the operating profit margin, GPM and OPM. Gross profit margin, let's say 50%, and operating margin 10% mean that is 40% of the gross profit you have spent on expenses. That means administration expenses, selling and distribution expenses, financial expenses. Therefore, you have to get an idea when you have a gross profit margin, net profit, operating profit margin. If you have a high cost part is there, then you can take cost controlling, reduction of cost. So cost minimizing strategy you can take with regard to that. For example, you can, if you say that marketing cost is high, you can reduce the cost, cut the marketing budget. Right? If the administration cost is high, you can actually do some administration manipulation, like you can reduce the wage cost, you can reduce the electricity bill, telephone bill. There are main methods like that. You can use that thing to reduce the cost. So that also we can find out from the ratio analysis in the financial statement. Okay, third one, increasing profitability. Now the advantage of using financial statement is you can improve your profitability. Okay, TJ, can you read that section?
It may be possible to use the accounts to help find ways of making more profit. For example, if the gross profit margins are small in relation to competitors, it may be because prices are too low or cost of sales is too high. Therefore, prices can be raised or new suppliers might be found for raw materials and other key resources. Perhaps wage costs need to be controlled more tightly. Profitability might also be improved if revenues are falling behind those of competitors. For example, perhaps a business should try to find new markets to help increase sales overseas, for example.
Exactly. So this is another thing that you can find out whether your operating profit, like your gross profit is low, and then you can say your profitability margin is low, then you can actually get some strategies to improve your profitability, like buying like raw materials from cheaper suppliers. For example, raw materials like other key resources. Sometimes you can find a new supplier in another country. Sometimes if your country is expensive, you can go to China, you can go to Vietnam, like for Asian country, or European country, you can find out another cheaper supplier. And also profitability can improve by if revenues are falling and behind those of the competitors. Fine, if your profitability going down because of the revenue falling, because of the sometimes the new markets, then you can find out to try out new markets, like new strategies you can find out to expansion into new market or introduce a new product, product development, market development, diversification, market penetration, different strategies you can have with increase the profitability, increase the competitive advantage. Right. So that's another advantage you can find out, not only reducing costs, you can find out the ways to increase your profitability. Okay, the other one is investment decisions. Investment decision fund, I invite Ranusha, can you read that section?
Investment decisions. Investment decisions are risky and uncertain because the business can never know for sure whether an investment project will generate returns in the future. The future is very difficult to predict. However, information in financial documents might help managers assess whether the business is strong enough to take risks. For example, if the statement of financial position shows that a business has high levels of cash and modest levels of debt, this suggests that investing in new ventures might be appropriate.
Investment also is very important because the amount of money that you are raising and you are reserving, sometimes you have to invest. Sometimes people are investing in fixed deposit where the bankers will give you about 5%, 4%, 6% interest rates. Or sometimes people are investing in other ventures. Sometimes they are buying foreign, sometimes the countries, for example, let's say they're purchasing fixed asset. Sometimes they're purchasing lands, apartments, sometimes warehouses. This real estate, sometimes they are buying and keeping. These investment projects are really important. If you have a certain amount of money, this money would be definitely, if you say the financial position is strong, then you can actually statement of financial position showing that business have high level of cash and modest level of debt. Sometimes you can use that money to settle your debts also. Then you can actually get rid of your debt and then you can use that money wisely. Therefore, investment decision is important. Investment means not only share market investment in real estate, investment on machinery, investment of vehicles, investment of sometimes you can settle your bills, you can settle your debts, bank loans and leases, or sometimes you can invest in another company because like business acquisition, mergers and acquisitions, that also possible. For example, in Sri Lanka, a couple of years ago, a Haley's company, they bought from their retained profit by giving 22 billion, they bought Singer company. Singer is an international firm. They acquired that company. Now Singer is under more than 150 years of the brand value. And you can see that company, the brand, they have bought by the Haley's. They acquire. So like that, this was another kind of investment, business mergers and acquisitions. So these are everything you can do by using the financial statement. Therefore, this is really, really important. Okay, we're going to the final part, the topic, other users of financial documents. Specifically, they are all external stakeholders. We are talking about one by one, these external stakeholders, the government, competitors, media, tax authorities, auditors, registrar of companies. Simply, if I say government want the accounting to find out whether how much tax they have to pay, collection of tax. Competitors want to know the financial information of a business to compare their level and their level. Comparison purpose, they find it. Media want information, news. So they will looking always at financial results for report some news. Whether this company report this much of profit, or this profit gone down, like that, the media always looking for news. Expansion projects, business acquisitions, mergers, they're announcing that to the public. Tax authorities are looking for financial, taxation. Auditors are looking at the financial document. This is their job to check the books. The auditor's main job is actually checking and vouching and verifying the accounting books. So that is their job. So auditors are looking at the accuracy of the data. And registrar of company want this information annually to renew the license. To renew the license as a part of the Companies Act, they have to call all the financial reports, what's happened during the year, if you want to register renew your licensing. So like that, these are the main, like in summary, I told you, one by one, what they want. For example, government, you can say, they made government this information, they can gather from the public, and then some data, they take an account, especially to find out the economy. To find out, government want this information to calculate the economic decisions, progression of the economy, what is unemployment, what is the production, how much money they generate, like that. especially central banks and everything, organization, they are collecting this information for statistical surveys to find out, to formulate the economic policies. And also competitors wanted to, as I told you, make comparisons. Yes, they're thinking about the takeover sometimes. It will be helpful to make a decision to go through the financial statement. They can find out the financial healthiness of the business. Media for news, you can see they want to specializing on some making some reports, media report, like example, Financial Times newspaper in the UK, like that. So every country, they have some financial information newspapers, like magazines, Forbes magazines and all. Tax authorities mainly to calculate the income tax of the business, corporate tax of the company, like that, value-added tax, excise duties, everything. In order to calculate, the government use that. Auditors mainly check the independent accounting firm. They are checking the vouching and verification. They want to find out with the process of checking the accuracy of accounts. We call the auditing. So checking mainly, and then if they found out some kind of like a manipulation, mistreatment, they will address it and they will disclose it to all the shareholders. That's their job. Registrar of companies in limited companies, PLCs, mainly the registrar of company wanted to have. They need to you have to submit a copy to the registrar of company every year because to get the license of the company license renewal. This is really important document available to general public. After that, to the registrar of company. These are the main other stakeholders. So today's lesson, we mainly target on, we address actually information regarding the financial statements. Who are the main users of financial statements? Internal users are mainly managers, employees, and owners, shareholders, and external stakeholders. We talk about they can take the different decision making, like funding decisions, cost cutting decisions, profitable increasing decisions, and also investment decisions. They can take 4 types of decisions we discussed. And finally, we talk about the different types of external uses of the business information, such as government, competitors, media, tax authorities, and auditors and registrar of companies. These are the main things. So today's lesson mainly can see it's not very theoretical. Small business as well as large businesses, they are using this information. Specifically, many small businesses, they do not produce organizations like financial accounts because it's costly for them. Sometimes they do not know, right? And what's large business, medium-sized business, they have to provide the full set of accounts to disclose to shareholders, therefore, to assess their performance and other businesses. So normally, small business owner may look into the amount of profit made for the year, right, which can be calculated accurately by an accountant. However, once the business is large enough to produce accounts, right, like a limited company or something, and then the documents are likely to be used for the purpose of describable. Mainly for large businesses, actually, this is more applicable than the small business, because only these processes, large business only, they need to have a pay taxes and auditing, everything done for only for private and public limited companies only. Because sole traders, they don't need auditors, they don't need tax authorities, they are not paying any taxes, right? They are not sending their copies to company registrar. This is regarding only companies or limited liability companies, right? So I hope you enjoy the lesson, right? If you have any question and everything, you can ask. You can send me a question in the comment line. You can chat me. You can actually send me any query, right? So I hope you understand the lessons. That's the entire financial management part we end from this chapter. So in my next sessions, I'm going to do more revision questions with you before we start the production management session. Okay, I hope you enjoy the lesson. Then thank you very much.